Dollar bulls will definitely have a lot to look out for this upcoming week with the latest CPI report out on Wednesday. This is the week ahead at XM.com. Thanks for joining us. I'm Christina Marujos, and with me today is our lead market analyst, Rafi Boyajian. Rafi, before we look at the data, let's look at what's making headlines these past few days. Trump's tariff threats keep making the news and, of course, causing a lot of volatility in the markets. Now, a de-escalation in the rhetoric seems rather unlikely at this point. So moving forward, what should investors be on the lookout for?
Well, Christina, as you said, Trump has been dominating the headlines. I think that's the thing about when it comes to de-escalation, what you were referring to there, because, of course, we have supposedly seen some de-escalation. At least the markets are reading this as a de-escalation following the announcement that Trump has given some reprieve to the Mexicans and the Canadians. They've got 30 days to negotiate a longer-term solution regarding the border issues that Trump is so keen on resolving with those two neighboring countries. But of course, we haven't seen any reprieve with the Chinese tariffs. So as far as we know, the US will go ahead and impose 10% tariff on all Chinese imports. So there was some optimism regarding the fact that China didn't retaliate too aggressively. They came up with only some limited countermeasures. And of course, you cannot rule out the possibility that some kind of a compromise will be reached because, of course, President Trump and Xi Jinping, they haven't actually held direct talks yet. So when they do have those talks, potentially there's room there for some kind of negotiation. However, even if we go with the assumption that President Trump was bluffing when it came to those, pretty harmful 25% tariffs, which would not only have hurt the Canadian and Mexican economies, but they would also have been damaging to the US economy as well, particularly when it comes to pushing up US inflation at a time when the Fed is kind of thinking about pausing its rate cuts. I think markets might be over-optimistic in terms of the US and China reaching some kind of a deal because the Trump administration does need to raise some revenue so they can fund their tax cuts, particularly the corporate tax rate reduction, which they've been talking about so much. So there's possibility that once markets maybe start to see that not only are those 10% tariffs against China here to stay, but there's a risk that they might actually go even higher. That could potentially lead to further turbulence. I think any calm we're seeing right now in the markets, probably temporary, or at least it's a very jittery calm. There's bound to be more headlines. And of course, all this is happening before we've even gotten to tariffs against the European Union. So there's a long way to go before all this tariff business is settled. And of course, it might never get settled. So I think markets are basically bracing for more turbulence. So the improvement in risk appetite we saw once those tariff headlines started to calm down, I think, we might see a further improvement, but I think, as I said, it's quite a jittery calm that we have at the moment. And potentially any new developments on the tariffs front or even on the geopolitical front, they could really be quite significant in terms of setting the market and the tone of the upcoming week.
It's definitely a story that keeps unfolding, and we'll be keeping on top of the latest developments. But let's turn to the data sets. And now that we have this upcoming week, staying in the United States, Rafi, the January US CPI report will be released and eyed, of course, as we saw inflation rising slightly in December. Do you think inflation will be back on the decline in January? And how would the dollar respond to that?
Well, inflation has been a bit of a problem in recent months because towards the end of 2024, we did see both CPI inflation and PCE inflation pretty much head higher, and we did see the consumer price index rise to 2.9%. So maybe we might see it edge lower a little bit, and it's the same with core CPI, which is still above 3%. So any improvement would, of course, be welcome. And even if we don't see much change, at least if we get some signs from either the month-on-month increases or within specific components of the consumer price index, that this upswing in prices since the middle of last year is starting to peak, and potentially in the next one or two reports we're going to see deceleration in inflation. I think markets would take that as a positive sign, and we could potentially see rate cut expectations getting a boost, but of course all that would be negative for the US dollar.
And finally, Rafi, crossing into the United Kingdom, the Bank of England lowered its interest rate by 25 basis points this week, but of course maintained a cautious stance on further reductions. Now, this upcoming week we'll be getting GDP data for quarter 4. How might the pound respond to that?
So UK growth is basically center of attention. It's a real concern for the Labour government, because they've received a lot of criticism that all the measures announced since they've been in power don't go far enough in terms of providing a real boost to UK economic growth. The Bank of England is worried about GDP growth because we haven't seen inflation hasn't come down as fast as expected. So now they're facing the prospect of stagflation, and investors, of course, they've kind of questioning the UK's longer term growth prospects, and this has been weighing on sterling. And we've seen from the monthly GDP readings that the UK economy didn't do so well in the final 3 months of 2024. Potentially, we might get a small negative reading for the fourth quarter, and this would probably weigh on sterling. I don't think we would get much. I don't think we would get a particularly strong sell-off necessarily in sterling should we get a negative reading, unless of course it's a real bad, very big drop in GDP. That's unlikely. But on the other hand, should we see any upside surprise, maybe a surprisingly strong GDP print, that could potentially lead to some solid gains for the pound, which, by the way, didn't really suffer so much during all those days of tariff headlines the same way as the euro and the Canadian dollar and Mexican peso did, because of course Trump has said that UK isn't really top of its priority when it comes to tariffs. So there is some potential for of course, the pound did come under pressure on the back of the Bank of England's rate cut, but it's possible the pound could rebound should we get an upside surprise in GDP, whereas a negative reading would probably just reinforce the bearish picture, the current bearish picture for the pound at the moment.
Rafi, thanks so much. This was The Week Ahead here at XM.com.